Good afternoon, everyone. Thank you for listening today. Today is Wednesday, March 18th, just before market close. We've had many requests to give an update on the state of the markets. So today we have portfolio manager and managing partner, David Havland, to provide you with an update. So without further ado, let me turn it over to Dave.
Thanks, Courtney. Please let me begin today by repeating a phrase from President Roosevelt's 1933 inaugural address that just seems quite apropos. We have nothing to fear but fear itself. COVID-19 is here. It is not to be taken lightly, and our society has now realized what is necessary to combat it. Social distancing is now part of our vocabulary. Work from home for many is real. Global trade, commerce, the movement of people, and many other facets of our lives have changed. Yet it seems the markets are reacting, perhaps overreacting, not so much as to the virus and its medical threat, but rather to the world's efforts to contain the virus. Whether it's school closures, office closures, supply chain disruptions, shortages, these are all reactions to fear, the fear of getting sick. We need to remain calm. We need to keep things in perspective and move onwards with our lives. Yes, this is concerning, but panic and irrational behavior rarely give a good outcome. If you are seeking accurate information on COVID-19, please do not listen to the media, let alone social media. Misleading and inaccurate information abounds. Please go to the websites that you see on the screen, and here you can get accurate information from the health experts, the Centers for Disease Control and the World Health Organization. We hope this helps, and let's get started with what has been happening. As the slide says, this type of volatility is literally unprecedented. The chart does illustrate how the volatility began to pick up. And it's one thing when markets are gyrating between 2 to 4% and then 5 to 7%, but lately we've been having moves in the 9 to 12% range, which is rather unsettling to say the least. The last time there were 3 or more days with a 9% or more move last happened in 1929. What is unique about this bear is the speed of this bear. It is actually faster than 1987. If you look at the chart and you see that dark blue line, that is what's happening now. That yellow or golden line that is to the right of it is 1987. And yes, 1987 had a 23% drop in one day, but as you can see, the bear took a lot longer than that. And even the black line slightly to the right of that is 1929. So as you look at these, you realize that the speed of this reaction, as well as the magnitude of this reaction, has never been seen before. And again, to explain this chart a little bit further, the bottom axis is time. And what we have always noted is that bear markets usually take months or years to unfold. So far, this one has been measured in days. This slide looks at the exact same data, but it removes that 25% threshold. And obviously the red line is what we're dealing with today. And then you can see most of the major bear markets of the last 100 and 125 years and what has happened. No one knows what's going to happen with this one because we've never dealt with a pandemic like this in the modern era. But what we do know is that, again, the speed and the magnitude of it has been rather shocking. The VIX is actually a fairly new index. The volatility index was created in 1993, but this too is flashing a signal that the markets are acting like the end is near. And it's classic in that investment decision-making being based on emotion, and fear, let's face it, is one powerful emotion. So inasmuch as COVID-19 has been an exogenous event that has not been seen in the modern era, there's a whole other black swan that has actually occurred at the same time. And I'm not aware of any time in history where 2 black swans happened at the same time. So what are we referring to? If you remember, it was only about a week ago that Russia was being asked by OPEC to join them in production cuts. And when Russia balked, the Saudis and the rest of OPEC reacted by lowering price and flooding the markets with cheap oil. And what they're essentially trying to do is punish not only the Russians, but let's face it, the U.S. oil and shale industry, because the United States is now the largest producer of oil on the planet. And what they're trying to do is to knock out weak producers to then eventually allow prices to rise and production to stabilize. Ironically, this is the exact opposite of the oil shocks that OPEC caused in the 1970s. Here, they dramatically increased prices and lowered supplies. And for those of you who remember waiting in those gas lines, that was not a lot of fun, but this is the polar opposite. The worry right now is mainly around the solvency of the U.S. shale producers and their bondholders. And what the situation did is took a rather orderly market and added a dose of uncertainty that just spooked the markets even further. If we throw in the fact that this is an election year where American socialism became a real possibility, we have a triple witching of sorts. So a lot of good things have started to happen, but the markets reacted counterintuitively. First, about a week ago, the Federal Reserve did a 50 basis point intra-period cut to the short-term rates. And then a few days ago, they cut again intra-meeting by a full point to near zero. And as we'll see on the next slide, they didn't stop there. This is a chart of the Federal Reserve's balance sheet. And if you look back in the gray area, right around 2009 was when the Fed started the quantitative easing process. And back then, the balance sheet was about $800 billion. They bought U.S. Treasuries and mortgage-backed securities worth $3.6 trillion to help us all get out of the Great Recession. Now they've pledged an additional $1.5 trillion of quantitative easing, plus the repo markets, commercial paper, and other short-term facilities that are either in force already or being implemented as we speak. If you go to the way far right of this slide, you're going to see what we're talking about, and that's that blip way over on the right, as the Fed recently has already repurchased about $100 billion worth of bonds from the open market. And they're going to do this right across the curve to try and keep interest rates low across the curve. This chart has, to me, a bit of irony in that who is actually reacting correctly to this coronavirus? China, who I'm sure most of our listeners are aware was the epicenter and origin of the COVID-19 virus, their stock markets since the beginning of the year have actually held up very well. And you can see not only Italy leading the pack down, but the rest of the major world markets are also reacting much more draconianly. A second note is that technology is still a leader in this market. It has been doing better than most sectors and still is providing a leadership. Note that is also an interesting concept is technology could actually be a big winner out of this, certainly a beneficiary, as the concept of working from home, cloud capability, having hardware at home and at work, all of these may add up to technology being the big winner out of this whole situation. So there still are many concerns that are out there. The first is just to actually recognize the fact that COVID-19 and our reaction to it is at this point going to force a global recession. It doesn't mean it has to be deep, and it doesn't mean it has to be long. And what is also a little bit ironic is this is necessary, and it's a self-inflicted exogenous shock to the economic system in our attempt to control this virus. As I'm sure you've heard on the news, and it's pretty obvious that many industries are going to be affected much worse than others, whether it's the travel and airline industry. Who we're most concerned about are all those small businesses that are out there, all the restaurants that are now not being able to serve food, but they still have all their fixed costs continuing. So any business with either a low cash amount or a low margin business are especially at risk. In terms of unemployment, well, we've already heard about furloughs and people being laid off, and certainly this trend is likely to continue. But we also point out that all these store closings, once they open back up when we've defeated this virus, that they are most likely to get rehired and go back to work. Another point is that consumer spending will likely be curtailed, but demand will likely be either just delayed or just bought online. So we see a lot of reasons for optimism here. And the biggest is that there has been no apparent misallocation of capital. In many of the bull runs that preceded the major bear markets that we saw earlier, there was a massive misappropriation of capital. And what we mean by that is the markets either got way ahead of themselves, there was a lot of debt in the system, or another shock, if you will, came from the commodities, as I mentioned earlier, OPEC and certainly 73, 74, but there were actually two shocks in the 70s that caused those gas lines. That disrupted our economy because we went from incredibly cheap oil measured in single dollars, and all of a sudden we had to pay as much as 20 times for that same energy input, and it was an intense shock to the system and caused a recession. Another reason for optimism is it's not like the Federal Reserve or other central banks around the globe are waiting to react. The reaction by the central banks has been swift and quite convincing. Just looking at 150 basis points by the U.S. Federal Reserve, in the past, they've been criticized as waiting too long to act. Here, they actually spooked people by acting, and the reaction to the Federal Reserve cutting was, wait a minute, is it worse than we thought? So the markets actually reacted to both of these cuts by going down. What we think may turn the tide is the massive stimulus packages that are now being discussed. Listening to the news, somewhere between $1 trillion and $1.3 trillion right here in the United States alone. And as a side note, since this is not political or associated with anyone or someone to blame, it should pass and pass quickly in both the House and Senate. But what we also note is China is not only what we talked about before, where their market's doing better, but there's a lot of anecdotal evidence of their economy reigniting. And as folks begin to go back to work, what we're noting is it's been 3 months, and many in China are going back to work or have gone back to work. And so if this is a 3 to 6 month phenomena and we can use that as a proxy, then again, that does not mean this is going to be a deep or prolonged recession, or at least doesn't necessitate that it be a deep or prolonged recession. And then the final note is, unlike 2007, when the U.S. consumer had piles of debt and was in a very weak position, the U.S. consumer has done a great job of shoring up its balance sheet in both increased savings and in getting their financial house in order in terms of reduced debt. So since the consumer is 2/3 to 70% of our economy, we look at this and say, all right, the consumer's strong and we're reacting with fear right now, but this could turn around very, very quickly. So in terms of our positioning, I think most of you are aware that we do have 3 systems that we use to manage money, and they are all growth systems, but have various degrees of defensive capability. First, let's talk about our paradigm system. So here, the U.S. equity allocations are currently 94% in short-term fixed income or cash proxy ETFs. Our weekly sector rotation U.S. equity positions and the international equity positions are now as much as 100% in short-term bond positions. And the only equity that is left in the weekly portfolios is the global macro allocation, which is only 10 to 15% of the portfolio as appropriate. Our decathlon series, the amount of defensiveness varies by the series and the risk profile, but the system as a whole has reallocated to substantial fixed income exposure. What we just want to point out to everyone is we gave the date, the 18th, as of this recording, and we just want everyone to know that all 3 of our systems are quite active, and the positions are sometimes changing many times within a week. But we just want everyone to understand that this goes both ways. If the markets continue to deteriorate, any remaining equity could be removed from the portfolio, or conversely, if all of a sudden we get some kind of rally of import, especially with a good catalyst, then our systems can get back into the market as well. So that about wraps it up. We thank you for listening. Thank you for your business and support. And please contact us if you've got any questions.
Thank you, Dave. Thanks for the update. We hope you all found that helpful. If you have additional questions or would like to speak with your BCM regional consultant, you can either visit our website, investbcm.com, or you can email or call the information on the screen. For more insights from our investment team, please visit blog.investbcm.com. Thank you.
All righty then.